So let's say I go to the share of Axis Bank. Okay, and here you can see the option for buy and you can see the option for sell. So here you can see that the price is fluctuating every second, right? Okay, so let's say I go to the buy option. Okay, so here you can see different options like quantity. Here first of all you can see in that you have to choose whether it's an intraday order or a delivery. Then here you can see the 4 types of orders. So market, limit, SL is stop loss, so stop loss, limit, stop loss, market. We are going to discuss about all of these in today's video, and there's also some complexities like this is cover order, this is aftermarket order. We are going to discuss about all of this. So let's start with the discussion. Now first, just a quick recap of what is intraday and what is delivery. So if you choose delivery, like there are 2 options whenever you buy or sell a stock. So the first option is intraday and second option is delivery. So if you choose delivery, so you can square off your position at any amount of time. Okay, so let's say you bought a share today. So you can sell it after 1 day, after 2 days, you can even sell it today, you can sell it after 5 years, 10 years, 20 years, it's your choice if it is a delivery order. But if it is an intraday order, then you need to square off your position on the same day. So if you have bought the stock first and if it's an intraday, then you need to sell it off today itself. And if you have done a short sale, then you need to buy it again today itself if it's an intraday order. And for short sale, like I told you in stocks in the previous video, that it needs to be an intraday order. Okay. Now let's come to the 4 important orders, which is market order, limit order, and again we have stop loss order, which again has 2 types, which is stop loss market and stop loss limit. Okay. So these 4 orders are according to the price at which you want to buy the stock. Okay. Now let's discuss one by one each of them. So first let's discuss market order and limit order. Okay. So you know that the price of the share keeps on fluctuating, right? So let's say that you have decided to buy a particular share and you place a market order. Okay. So in that case, the system will just ask you that what is the quantity which you want to buy. So let's say you say that I want to buy 10 shares and you place the order. Okay. Before going forward with that, I want you to understand 2 things. One thing is placing an order and one thing is the order getting executed. So if you place an order, you are basically telling your wish that I want to buy this particular share at this price, this much quantity or whatever, right? And the order getting executed means the order has matched. So if you are buying, you have found a seller which is agreeing at the same price, same quantity for the same share, right? So when you placed, so one thing is you place the order in the system. So you give an sort of instruction that I want to buy or I want to sell this particular share at this price and all that. And the order execution, the order gets completed. So when you place an order, it is called open order. Till the time it gets executed, it will be called as an open order. And once the order is confirmed, once the order is executed, it will be shown under closed orders. Okay. So now let's come back to the market order and limit order. So let's say you have placed a market order. So they will just ask you the number of shares which you want to buy. Let's say you say that the price is fluctuating. So let's say the price is right now at 100 and it's fluctuating between 99 and 101. Okay, it's like you know that the price is continuously fluctuate. Okay, so it's continuously fluctuating between 99, 100, 101. Okay, and you place a market order for 10 shares. So after you place the order, at that instant, whatever will be the price of the share, you will just get the order for 10 shares. If someone else is ready to buy 10 shares, is ready to sell 10 shares, right? So market order is basically that you do not want to bargain for the price. You just want 10 shares. Whatever is the price, I'll just buy it. Okay. Now let's come to the limit order. So like I told you, you are seeing that the price is fluctuating between 99, 100 and 101. Okay. Now you place a limit order, and when you place a limit order, it will also ask you the price at which you want to buy. Okay. In market order, it won't ask you for the price. So now in limit order, let's say you entered the price as 98. So right now it's fluctuating 99, 99.5, 100, again 99.5, again 100 and 100.5, like that is fluctuating. Now you have placed an order, limit order for the price of 98. So what this means is whenever the stock reaches the price of 98, your buy order will automatically get executed. Okay. So this is the concept of limit order. Now, why is there a concept? What if I decide that, okay, when the price will come at 98, that time I'll place a market order for buying. But it's quite possible that the price came to 98 for just few seconds, and till the time you place the order, it again became 99. So that's why we need something known as a limit order. So I'll place the limit order for 98 and I'll just keep it in the system. The order will be open. It will not be executed yet because right now the price is fluctuating between 99 and 101, right? but I have kept the order open. I have placed the order for the price of 98. So the moment it reaches 98, my order will get executed. So till that it will remain in open order. It will not get executed till then. But once the price reaches 98, it will be a closed order. So order will be confirmed and the order will be executed, right? So this was the basic difference between market order and limit order. So market order means I want 10 shares, just buy it whatever the price may be. Okay. And limit order means I am specifying a particular price. Whenever the share comes to this price, I am ready to buy it, right? Okay. So one important thing which I want you to note here is that whenever I say that this price in limit order, when I say that I want to buy at this price, it's not necessary that that is exactly, so when the LTP reaches that exact price, only at that price I'll buy. Okay. So now imagine this situation that the price is ranging between 99 and 100 right now, and you have placed a limit order of 95, let's say. So right now the price is between 99 and 100, but you will buy only if the price comes to 95. Okay. Now what if the price doesn't come to 95, it comes down to 94 directly. So what will happen? Okay, so in that case also your order will be executed because you were ready to buy at 95. Okay, so whenever you are buying, you want to pay the less price as possible, right? So whenever I see that the price is right now between 99 or 100, but I have placed the order of 95 limit order to buy. So it does not mean that if it reaches exactly 95, then only my buy order will be executed. If it reaches 95 or below, then it will be executed because I am buying. So I want that the price should be low. So I am ready to give maximum 95 rupees when I am buying. If it's lower than that, very good. I am ready to buy at 95. That is the maximum price I am willing to pay. And when I'm selling, I want to sell it at the maximum price. Okay, so right now it's between 99 and 100 and I want to sell at 105, let's say. So I have placed a limit order to sell at 105. But let's say it reaches directly 106. So great, I was ready to sell even at 105 and now it has reached 106. So I am obviously ready to sell, right? So when I'm talking about limit order and you have placed a buy order. So let's say your limit price is 90. And if it's a buy order, then if 90 or below 90 the price is gone, if it goes directly below 90, then your order will be executed. And if it's a limit order to sell, so your limit price is let's say 110 or 105. We took example of 105, so let's stick to that. So if it's 105, so if it goes 105, exactly 105, or if it goes directly, it goes above 105, then also your order will be executed, right? So limit order is basically saying that if it's a limit order to buy, this is the maximum price I am willing to buy it at. So less than or equal to this price, my order will be executed. I am ready to buy. Okay. And if it's a limit order to sell, then greater than or equal to that price, I am ready to sell, right? Because obviously when you are buying, you want to pay the least amount possible, and when you are selling, so you want the buyer to pay the most amount, the highest amount possible, right? Now, one important thing to note here is that these market order and limit order, which I am explaining to you right now, these are applicable for buy as well as for sell. Okay, so let's take the same example. The stock is fluctuating between 99 and 100. Okay, and let's say that you have already bought the share previously at 95. So right now you are sitting at a profit because you had bought at 95 and currently the price is fluctuating between 99 and 100, right? So you can place a limit order that as soon as the price reaches 100, you can sell it. So a limit order can be a buy also and it can be a sell also. Similarly, a market order can also be buy and it also can be sell, right? Okay. So now let's come to the most important part of this video, which is stop loss. Okay. So the name itself suggests stop loss. Okay. So I want to limit my losses. Okay. So now I'll give you two cases. Okay. So the first case is, let's say that you have bought a stock at 100 thinking that, let's say I think that it will go to 120 or 130. Okay. But I also have a fear, right? What if the stock goes down? What if whatever I had predicted or whatever I had studied about this stock is not true? Okay. So you think that the stock will go to 120, 130, but there's also a risk, right? What if the stock goes down? So now let's say that the price is 100 and you have bought 10 shares. So it's a 1,000 rupee investment on your side. So let's say that you're thinking that, okay, I've invested 1,000 rupees. I don't want to take more than 10% loss. I don't want to take more than 100 rupees of loss. Okay. So if the price reaches 90, so your 1,000 rupees will become 900 rupees. So that's a 100 rupee loss. So that is the maximum loss which you want to take. Okay. If your target is, let's say that it will reach 130. So in that case, you will be at a 300 rupees profit. Okay. So if things go according to you, it will be a 300 rupees profit, but you also have a fear that what if it goes down? So in that case, you want to limit your losses, that I don't want to take more than 100 rupees of loss. So what you can do is you can place a stop loss order at 95 rupees. So as soon as the price reaches 95, it will get automatically sold off. Okay. So what now, let's say that at 90, let's say you bought it at 100 and you placed a stop loss order at 95. The price came down to 95 and it got executed. It got sold at, not 95. Our example was for 100 rupees of loss, right? So it will be at 90 rupees. At 90 rupees, you will be at a 100 rupee loss. If the price goes down to 90, so 10 rupee loss per share and 10 shares, so 100 rupees of loss. Okay. So let's say that you had bought it at 100 and the price went down to 90. So the order got executed and you incurred a loss of 100 rupees. Now the price went down to 85. But you are not bothered about the price because you have already sold it at 90. So your loss is fixed. You cannot incur more than 100 rupees of loss, right? So this is the benefit of using stop loss order. Now you can use this for profits as well. Okay, so in the same example, you had bought it at stock at 100 rupees and you thought that the price will go up to 130. But suddenly after 2-3 days, when you open your demat, not after 2-3 days, let's say after 2 weeks, you open your demat account and the stock is at 140 right now. So you had thought that it will be 130, but the stock is right now at 140. Now you are thinking it can even go further up. It can go up to 150, 160. So should I hold it or should I sell it right now? What if it goes down from here? So in that case, you are actually sitting at a profit right now because you had bought it at 100 and right now the price is 140. So this 40 into 10, so 400 rupees is your profit right now. So you can place a stop loss order at 130. Okay, so what you're doing is if the price goes till 130, sell it. So at least 300 rupees of my profit is sure. Okay, so if it goes up, no problem. If it goes to 150, 160, very good. I am very happy. But if it goes to 130, that's it. Sell it off. I want at least 300 rupees of profit, right? So the concept of stop loss is that if the price goes below this, then sell it. Okay, now this same thing can be for a short sell also. Okay, so let's say you sold the stock at 100 rupees. Okay, so you want that the price should fall till 90. But let's say the price increased till 105. So in that case, the stop loss will be a buy order. Okay. So, and again, you can do the same example for the profit as well. So let's say you had short sold at 100 and it went to 90. Now you can place a stop loss buy order at 95. So at least that 5 rupees of profit will be confirmed for you, right? If you don't know about short sell, then I will tell you to, I'll request you to watch my previous video. Okay. So this is the basic concept of stop loss, that if the price goes beyond this, just sell it or just buy it. Okay, now that sell or buy will be the square of the reverse position. So if I had bought initially, then the stop loss will be selling. And if I had sold initially, then the stop loss will be a buy order. Okay, so this was the main concept of stop loss, that whatever I had thought, it is not happening. So see, I want to limit my losses, right? So when I had, let's take this, the initial example that I had bought it at 100 and I want that it will go till 130 and 130. But right now it's at 90 rupees. I had thought it will go to 130, but right now it's at 90 rupees. So stop loss is basically that what I had thought has gone wrong. And now I'm sitting at a loss of this 100 rupees. So I want to book my loss right now so that I don't incur a bigger loss, right? So right now I'm sitting at a 100 rupees loss. But what if this loss increases to 200 or 300? I want only 100 rupees loss. I cannot take more loss than that, right? So you are kind of limiting your loss at 100. And in the case of profit, you are ensuring that this much profit is fixed for you, right? So like if let's say that the same example, you said that your target was 130, but it had gone to 140. Okay, now from there, let's say the price came down to 120. So you are still at a profit because you had bought at 100 and you are now selling at 120. But it had actually gone to 40, right? To 140. And now it's at 120. So that is a kind of a loss of profit for you. Okay, you could have made a 400 rupees of profit, but right now you're making 200 rupees of profit. So you can also use stop loss for loss of profit, right? I hope I make sense. Okay. So this is the basic example of basic concept of stop loss, that what I had thought is going wrong. I had thought that this will happen, but the opposite of that is happening. So right now I am at a loss, so that I want to book my loss right now so that I don't occur a further loss. I don't occur a bigger loss. I want to stop my loss at this much amount, right? Now in stop loss also there are two types, stop loss limit and stop loss market. It's the same example of the limit order and market order which we took. So market order means a fixed price and limit order, not a fixed price. A market order means whatever is the price, just sell. And limit order means I want this fixed price. Okay. So in stop loss also we have stop loss market and stop loss limit. So now let's discuss about stop loss market and stop loss limit. Now first let us discuss about stop loss market order. Okay, so now like I told you, you have bought it at 100 and you don't want to incur more than a loss of 10 rupees per share. So you don't want a loss of more than 100 rupees. Okay, so you place a stop loss order at 90. Now first we are talking about stop loss market order. Okay, so this 90 rupees of price which you have placed your stop loss order, in case of a stop loss market order, this 90 rupees is known as the trigger price. Okay, so you can understand it kind of. So the trigger, the word itself says, like the order will be triggered, or it will be like an alert, right? So once this trigger price of 90 is hit, the next I should say microsecond, whatever will be the price, just sell off the shares. Why this thing of whatever the price? Because it's a stop loss market order, right? So I explained you the concept of market and limit order, right? So stop loss market order means once the trigger price is hit, just execute it at whatever price the next microsecond it's available. Okay, so in case of a stop loss market order, this trigger price and the price, so 90 rupees was the trigger price. Now let's say that the next microsecond the price became 89.9, so it will get executed. Okay, now it's also possible that the next microsecond the price became, the trigger was hit at 90 rupees. Now the next microsecond the price became 90.1. Okay, or it's also possible that the next microsecond it stayed the same, 90. Okay, so this difference, so you placed this trigger at 90 rupees and in the first case your order actually got executed at 89.9. So this 0.1 rupees is called as the slippage. Okay, so it can be positive, it can be negative, it can also be zero. So if the price stayed at 90 rupees for the next microsecond and it got executed at 90 rupees, so your shares were sold off at 90 rupees, so the slippage is zero. So the difference between the trigger price and the price at which it actually gets executed, that difference is known as slippage. Okay, so you can understand stop loss market order in like a combination of two things. The first one is an alert or a trigger. Okay, so in case of stop loss market order, the first thing is a trigger. In that case, the order will be alerted that now next microsecond, whatever is the price, just sell it off, because it's a market order, stop loss market order. Okay, now let's come to the stop loss limit order. Now here there will be two prices. Okay, so again, not three prices. Okay, actually, so in stop loss market order we had two prices. So first you bought at 100 and 90 was the price at which it was a trigger price, right? So we had these two prices. Now we'll have three prices. So let's say you bought at 100 and you placed a trigger at, let's say, 92. Okay, and the limit price you placed at 90. Okay, now remember the concept of limit order, that I want to buy or sell at this particular price, right? I want to bargain. So what will happen is the price of the share is right now at 100 and the trigger price is 92. So once the order comes to 92, it will be an alert. Okay, so it's an alert for you as well. Okay, so let's say that the price has come down to 92 and the limit price was at 90 rupees. Okay, so the concept here is that after it reaches 92, the order will be alerted, it will be triggered. Then after it reaches 90, then a limit order of 90 rupees to the sell order will be executed. Okay, so the first case, stop loss market order, it was a market order. So whatever is the price, just sell it off. But here it's a limit order. So you are placing a limit price of 90 rupees. So the first thing is trigger price. So that was 92 in our example. The second price was limit price, that was 90. Okay, so first at 92, it kind of got triggered. Then once it reached 90, the next microsecond, a limit order will be placed that I want to sell it off at 90 rupees. Okay, now let's say that the next microsecond, instead of 90, the price came down to 89.9. Then the order won't be executed because you have placed a limit order of 90 rupees and the order is the price is right now at 89.9. Okay, so the order won't get executed. But if the price stays same, let's say it stays, the order got first it got triggered at 92, then it came to 90, and then even the next microsecond it stayed 90. So then it will get executed. So limit order is this is limit order, right? So I want to buy exactly at this price. I do not want to pay more than that, or I do not want to sell for less than that price, right? So when you are placing a buy limit order, you are saying that I do not want to pay more amount than this, right? Now let's quickly summarize stop loss market and stop loss limit. Okay. Now, first of all, stop loss can be a buy order and it can also be a sell order. Okay, so if you have bought first, and so let's say you have bought the stock at 100 and the price is falling, so that in that case you are incurring a loss. Sorry, not occurring. Okay, and let's say that you have short sold a stock. You have done a short sale. Okay, so you have sold at 100. So in that case, if the price is increasing, then it's a loss for you. Okay, so stop loss can be for both the cases. So if you have bought first at 100, then the stop loss will be a sell order, and if you have sold first at 100, then the stop loss will be a buy order, right? When you have bought first, then what is your fear? That if the price goes down, I will incur a loss, and I want to limit that loss to maximum 100 rupees. So that's why I'm putting a stop loss. In case of selling first, what is your fear? That if the price goes up, then I will incur a loss. I want to limit my loss at 100 rupees. So in this case, you have put your stop loss at 90, and in this case, you have put your stop loss at 110. Okay. So what happens in market order is, you have bought at 100 rupees and stop loss is here it's at 90 and here it's at 110. So that price is called as trigger price. Okay. As soon as that trigger price is hit, the order will be executed. Which order? Market order. Okay. So the next microsecond, whatever will be the price, the order will be executed. Here it will be a sell order, here it will be a buy order. As simple as that, right? And because it's a market order, so I told you, right? In market order, there is no bargain. It's just that these number of shares, whatever is the price next microsecond, just buy or sell it. That is for market order, right? Now let's discuss stop loss limit order. Okay. So now here there are two alerts. The first alert is the trigger price. So in the left side, you can see the example, the 92 is the trigger price. So at 92, it's kind of an alert for the system, and it's an alert for you as well, that if you want to change the price, let's say you don't want to sell it at 90 and you want to change it to 85, so you can modify your order. Okay, you can even modify it before the trigger price hits, but why I specifically mentioned this here is that it's a kind of an alert, right? I said, so you can see that, okay, the price has reached already from 100 to 92, so it might reach 90 anytime soon. So if I want to change, then maybe this is the right time. And similarly here, if it has reached from 100 to 108 and I don't want to buy it at 110, I want to change it, so this might be the right time. So first is the trigger price. At this, it's an alert and the system gets activated or alerted. Okay. Now the second is the stop loss price. Okay, which here is 90 and here in the right side it is 110. As soon as that price is reached, so in the left example, it is 90. So as soon as the price of 90 is reached, a limit order will be activated to sell at 90. And here, as soon as it reaches 110, a limit order to buy at 110 will be executed or activated. Okay. Now it's a limit order. Okay. So let's say that the limit order got activated and the next second after 90, the price became 89.90. So in that case, the limit order won't be executed because it's a limit order to sell, right? So I am saying that I want to sell at 90, but the next microsecond, the price reached 89.9, right? So it won't be executed. Similarly here, if I say the next microsecond, the price reached 110.05 or 110.10. So the price, I have set the price that I want to buy at 110. So if there is a price higher than that, then the order won't be executed because it's a limit order, right? So now what can happen is there are two cases. Okay, so the next microsecond, it went even lower than 90. Let's say in the left example, it went to 89, let's say. Okay, but after that, so it went to 89, but when it reached 90, the limit order got activated, that now if the price of 90 comes, then I will sell it. And here if the price of 110 comes, then now I will buy it. So what can happen is, so let's say that after 90 it came to 89. Then it fluctuated a little bit and let's say it again came back to 90. Okay. So now in this case, how stop loss limit can help you is that if it was a market order, so what would happen? So you place a stop loss market order. So at 90, the trigger price would have been hit and the next microsecond, the price became 89. Okay. And so what would happen in a market or in the stop loss market order is at 89, you would have sold. But now if in this case of limit order, let's say the price came back to 90 rupees. So now, since you had placed the limit order of 90 rupees, so now it will get sold at 90 rupees. It won't get sold at 89 rupees, right? So you saved that 10 rupees extra loss, right? In case of a stop loss limit order. But the big risk is, so like I told you, it reached 89. It can go even down 88, 87, right? It's possible that it might not reach 90 again. And here after 110, let's say it reached 111. After that, it's possible that it might reach 112, 113, and it might not come again to 110, right? So a big risk in case of stop loss limit is that the order does not get executed, right? And the advantage of using this is to save that extra, like I told you, so 90 and 89, whatever the price is, right? So this was the main difference between stop loss limit and stop loss market. Now there are various cases in both of these, that if the price reaches this, then after that this happens, then what? If after this the price becomes this, then what? So I'll discuss each of the cases one by one so that there's no confusion left in stop loss limit and stop loss market order. Now first let us discuss for stop loss market. Okay, so now the first case can be that the price after 100 it fell and it came down to 90. Okay, so the simple case is that it came down to exactly 90, so the trigger price was 90 and the order got executed. Now since this is a market order, there can be three cases like I told you. So the next moment, if the price can be greater than 90 also, it can be equal to 90 also, and it can be less than 90 also. So let's say that the first case is the next after, so at 90 it got triggered. The next moment, let's say the price was 90.10, so order got executed, it got sold at 90.10. So in this case, your loss actually it became less, right? So you wanted to sell at 90, but you actually sold at 90.10. Another case can be that the next moment the price was exactly 90, so you sold at exactly 90, or next moment the price can also become, let's say, 89.9, something less than 90, right? So now these three cases are cases of positive, negative, and zero slippage. Okay, so slippage is basically the difference between 90, so the trigger price, and the price at which the order actually gets executed, right? So the trigger price is 90, let's say the next microsecond also the price was 90, so you sold it off at 90. So in this case the slippage is 0, and if you sold it at 90.10, so in that case, or 90.10 or 89.90, so the slippage is 0.1, right? So and positive slippage is this. Okay, similarly, so here also you can see, so here also from 100 you can see that the same three cases, the price reached 110, and again the three cases of positive, negative, and zero slippage, right? So now let's say that what if this price is not reached only? So let's say that what if from 100 it came down, but it did not touch 90. Let's say it even touched 90.10, but it did not touch 90, and let's say after that it maybe fluctuated a bit more or whatever, but it did not reach 90. And similarly here also, let's say that it fluctuated but it did not reach 110. Okay, so in that case the order won't be executed. In both the cases the stop loss order won't be executed because the trigger price has not been reached. Okay, as simple as that. Now let's discuss the most interesting or the important case which I actually wanted to discuss, right? So that case is that what if the price directly jumps? Okay, so let's first take for the left side for this example. Okay, so let's say that it came down, and it came down to 90.10. Okay, and the next microsecond it did not wait till 90, it directly came down to 89.90. Okay, so what would happen in this case? Now just tell me logically, okay, why did you place this price at 90 rupees? Because you wanted to stop your loss. You wanted to you wanted that the maximum loss I want to incur is 100 rupees. I do not want more loss than that. Okay, so when the price was at 90.10, what your system showed to you was 99 rupees of loss. What your system, the next microsecond it reached 89.90, so now your system is showing 101 rupees of loss. Now you had placed a stop loss order to stop your loss at 100 rupees. So now you would say that, okay, I could not stop it at 100 rupees because from 99 the loss directly went to 101. So now at least stop it at 101, right? So here when I said that the price which reached 90, then the order will get executed, I mean less than or equal to 90. Okay, so if while less than or equal to, it can skip 90 and it can directly reach 89.9 or 89.5 or 89 in case of a very volatile market. Okay, so very volatile means the prices are fluctuating very quickly, right? So here also let's say that it reached 109.90, and after that it directly went to 110.10, right? So in that case also you'll say that okay, I could not restrict my loss at 100 because it went from 99 to 101. So now at least buy it at the market order, and now at least stop my loss, right? So here, when you have bought first and now you're going to sell at so you bought first. So what is your fear? That if the price goes down, I will place a stop loss. I'm placing a stop loss order for if the price goes down, right? So in that case, the trigger price is 90. So in that case, whenever we say that this price will be reached, then the market order will be reached, we should say less than or equal to that price, the order will be executed. And here, more than or equal to 110. So here, if the price reaches less than or equal to 90, the order will be executed, which is market order. The next microsecond, whatever will be the price, the stop loss order will be executed for selling it. And here, if the price reaches 110 or it directly reaches something above 110, then the market order will be executed, and again the next microsecond, whatever will be the price, it will be bought at that price. Again, the three cases of positive, negative, and zero slippage, right? So these were the cases for stop loss market order. Stop loss market order was very simple. Now let's go to the main complex, which is stop loss limit order. Okay. Now first of all, first case very simple. The trigger prices itself is not hit. Okay, so here in case of 100, when we buy at 100, the trigger price is 100 and is 92. So let's say it did not reach 92. It stayed above 92 only. It stayed till 93. It even went till 92.1, but it did not reach 92. So again, nothing will happen. And in this case also, it went to, let's say, 107.90, but it did not go to 108. It did not go up to the trigger price itself. Forget about the limit price. It did not go to the trigger price also in both the cases. So what will happen is the order won't be executed, right? Now let's say that the trigger price got executed. The trigger price was hit. So here let's say the price of 92 was hit. Okay. But after that, this limit price of 90 was not hit. So again the order won't be executed, right? Because in the case of stop loss limit order, there are two alerts. The first alert is just, it's a kind of alert. Nothing, no buy or sell order will be happening at that alert. But when the second alert, that is the limit price of 90 or 110 is reached, at that time the order will be executed, which will be the limit order in this case. But it did not reach 90, or let's say in the second case it crossed 108, but it did not reach 110. So again, nothing will be done. It will remain as it is. No buying or selling will happen, right? Okay. Now let's discuss again the same case which we discussed for market order. So 90. So let's say it again, same example. From 90.10, it reached 89.10. Okay, and here also let's say that from 109.90, it reached directly to 110.10. So okay, now first we understood that I wanted to stop my loss at 100, but it directly went to 101. So now at least place the order. Okay, so here when it reached 89.9, the order was placed. Okay, but the order was placed of 90 as the limit price, because you had said that already, right? So now the price is 89.9 and the limit order is of 90. So now you tell me, the price is 89.9 and your limit order is to sell at 90. Will it be executed? The answer is no. Here also the price reaches directly 110.10. Your stop loss, your limit price is 110, that I want to buy at 110. The current price is 110.10. Will the limit order be executed? The answer is no. Okay. Now here again there can be two cases. The first case is, okay, now here 189.9 was reached. After that, let's say it fluctuated a bit, but eventually it did reach 90. So in that case, the limit price will be executed. Or let's say it went above 90 also. So like we discussed for the limit order, so if it goes 90 or above 90, then the limit order will be executed. And here if it goes to 110 or below 110, then the limit order will be executed. But what if here it did not reach 90? It fell and it did not reach, it did not come back to 90. So the order won't be executed, even though I had placed a stop loss order, right? And in this case also, if it reached 110.10, after that it went on increasing, but it did not come back to 110. The order won't be executed, right? So even though here I had placed a stop loss order, but just because it was a limit order, so even if it went from 90.10 to 89.90, my order won't be executed and my losses will keep on increasing even though I have placed a stop loss order, right? So these were the cases for stop loss limit and stop loss market. So I hope you understood these, and yeah, so these were all the cases. one important thing which I want to tell you here is that if you are hearing about the concept of stop loss for the first time, then please make sure to make it your habit that whenever you place a buy or sell order, then automatically first there should be a stop loss in your mind that okay, I'm buying it at 100 right now, but if it reaches 90, then I will sell it and I won't wait for. So what happens is that let's say you have bought it at 100 and the price has reached 90. So what will you think emotionally that I've bought it at 100 and right now it's at 90, but let's wait. What if it reaches 100 again, right? So this should not be done. Okay, so whenever you are buying or selling any stock, so your stop loss and your target should be fixed in your mind. Okay, that I am buying at 100. If it goes to this is my target, I will sell. And if it goes below this, that means what I thought was wrong, so that I will execute my stop loss order, so that okay, I accepted that I am wrong, so that I am limiting my losses. Okay, because see, the thing is that no one can be correct in stock market 10 out of 10 times. Okay, the whole game or the whole thing behind stock market is that can you become so skillful that you can be correct at least 6 or 7 times out of 10. Okay, so even if you're correct, let's say 7 times out of 10, not even though that's a very good sign to be in, right? So let's say you're every time you place a trade, out of 10 trades, 7 trades are correct. What do you think? It does happen. Okay, so your 7 trades will be profitable and your 3 trades will be in loss. So overall you will still be in profit, right? But now there's a condition. Now let's say that in the 7 trades, let's say on an average you are making 1,000 rupees of profit in every trade. Okay, but now in those 3 trades your losses are like 10,000, 5,000. So what's the point of these 1,000 rupees losses? These loss. What's the point of these 1,000 rupees profit? Because here you are making such huge losses, so these profits will be washed away, right? So that's why this concept of stop loss is very important. Okay, now let's say you had set your stop loss at, let's say, 1,500 rupees. Okay, and let's say in those 3 trades, in all of the 3 trades you incurred a loss of 1,500 rupees. So now what happened? In 7 trades, each 1,000 rupees of profit. In 3 trades, 1,500 rupees of loss. So overall, if you calculate, you are still in a profit, right? So that is why you need to follow this concept of stop loss, and it's kind of a discipline. Okay, so if you are somebody who is new to the stock market, I'll request you to please follow please make this a habit of following stop loss. Okay, because most of the people who are the people who are like who have experience of stock market since 1 year, 2 year, 3 year or whatever, they know about this concept, they know about stop loss, they know about all of this limit, trigger price and everything, but they never put a stop loss order. Okay, they buy it at 100, once it reaches 90, what they'll do is they'll buy more so that the average becomes 95. Okay, so I'll make a separate video on what are the mistakes or whatever. I'll make a separate video on this, but please make it a habit to put a stop loss order whenever you are buying or selling in the stock market. Okay, so now let's go to the screen and let's see the live example of whatever we have learned in this video, that is market order, limit order and stop loss order. And again, in stop loss there are 2 types, which is stop loss market and stop loss limit. So here you can see there's the option of intraday and there's the option of delivery. So if I go to market order, I just have to type the quantity, let's say 10 shares. It won't ask me for the price, because the price, like I told you, for the market order, whatever will be the price at that moment, it will be automatically executed at that price, right? But now if let's say I do limit order, so now it will ask me the price, right? So right now the price is at 672, it's fluctuating around that. So let's say I say that when the price will come to 660, at that time automatically buy Axis Bank for me, right? So this is for the limit order. Similarly, I can do it for the sell order. Let's say I had bought Axis Bank previously. Let's say I had bought it at 600 and right now I'm sitting at a profit because it's at 672. So I can write here that when it goes to 680, at that time automatically sell Axis Bank for me, right? So now let's check out the stop loss orders. So first we'll see stop loss market, right? So here you can see only one price which you have to enter, that is the trigger price. Okay, so right now you can see the stock is fluctuating at around 672, 673, right? So let's say that I had bought the stock at 700. So now maybe my trigger price can be, let's say, 650. Okay, so at 650, if the stock reaches 650, then just sell it off immediately at market order, right? And similarly, if I do stop loss limit, so maybe this price will be 650 and maybe I can make the trigger price as 660 maybe. Okay, so when 660 the price is reached, then I will get an alert And if I want to change the price of 650, I can obviously change it, but that will be a good time to change it, right? Because I've got the alert that okay, now from 700 it has gone up, it has gone down till 660. So now anytime 650 can also be reached, right? So if I want to change that price, I can change it. And this price is the second alert. So when this second alert will be reached, that is when 650 will be touched, at that time the limit order for selling at 650 will be executed, or it will be activated, right? Not executed, it will be activated, right? So these were the 4 orders which are mainly important. So market order, limit order, stop loss limit, and stop loss market. So these 4 important things I should say these 4 important orders which we learned in today's video. And intraday and delivery, you obviously knew it, but I just repeated it once again, right? So actually I wanted to make this video even longer, and there are some more concepts which I wanted to include in this video itself. But I thought that this video has already become too long, and like someone who's understanding stop loss market, stop loss limit, all of these for the first time, the video is already too long, and you know it's already too much for one video. So I thought I'll cover the remaining concepts in the next video, and let's not rush things and just put everything in one video. So yeah, so I'll make types of orders part 2, which will be the next video, and they will cover the remaining concepts in the types of orders. So there are some small concepts, but if you have understood today's so market order, limit order, stop loss market, stop loss limit, then those concepts will be quite easy for you to understand, and that will complete the discussion on types of orders. So yeah, that was all for today's video. I'll see you in the next video, which is types of orders part 2. Till then, bye bye.